Hi, everyone. I'm Rosemary Miller here with Rob Isbitts, the founder and chief investment strategist of ETFyourself.com. Rob is here to tell us a few of his top pieces of advice for investing. Thank you so much for joining me today, Rob.
Oh, my pleasure, Rosemary. Let's get into it.
Well, Rob, before we talk about the current markets, could you summarize how you approach the world of investing for income, growth, and preservation?
Sure. I think it's always good at the outset to kind of know who you're listening to. So, my number one rule of investing is very simple. It's called ABL, avoid big loss. Everybody determines for themselves what big is. When I was a client advisor for 27 years before we sold the firm a few years ago, we had to do that individually. Now, as a writer, researcher, ETFyourself.com founder, we're getting it out conceptually. So, 30 years of investing, and a lot of things have changed over that time. But what I think is changing the most today is how the markets work and what influences them. And I think sometimes people get a little bit too caught up in how much can I make and not thinking about how much they can lose. So, rule number one is ABL, avoid big loss. Rule number two, frankly, make as much as you freaking can. Uh, but remember that one is more important than two. And that will always give you, I think, a baseline, a worst case scenario that you can work up from, as opposed to sort of floating along and then getting a big surprise. Because I've lived through a lot of those, starting in 1987 through 2000 through '08, and all the more recent ones. So, you're talking to somebody that started his career in 1986 in New York City, World Trade Center, and I used to walk by the Schwab office every day, and all the other brokerage firms back then, and it would have a you would look inside and you would see people lined up at the Quotron machine to punch in their tickers to see how their stocks did. I know you're giving me that look, and you should be, because who can imagine this today? Why can't you just get it from your phone? Well, it was way before the phone, etc. So I've seen a lot of changes over 38 years now in professional investing. So first, and a lot of these things are not market specific. I mean, 24/7 communication, something we didn't have, let's say, in the 80s or even that much in the 90s. Okay. I remember when my first child was born, I was carrying around a beeper, not a cell phone. So, and then for the second and the third, it was a cell phone. Online trading. Okay, it makes it so that anybody can do this. They can make investment decisions at in a flash. Um, Indexing. And of course, I'm ETFyourself.com founder. I mean, I've spent a lot of time in the ETF business, and ETFs, while they're not all index based. Most of them are. There's a lot of active ones, but a lot of them are based on an index. So instead of having one or two or three, let's say, stock market indexes back in the day that you would follow in the handwritten newspaper, okay, or the printed newspaper, okay. Instead, what we have now is uh, all of these indexes, and people invest in the indexes, and that makes it so that a lot of stocks, you think, well, why is my stock going down? Well, maybe because a lot of people are piling out of the index. There's a lot of selling of the index, and the index is a force to sell your stocks. So the nature of ETFs, and maybe we'll get into this in the future discussion, but the nature of ETFs, the presence of ETFs, and the dominance of ETFs taking money kind of from the mutual fund business has led to this also. And then there's things like algorithmic trading, uh, which we didn't have this element before, where they have the ability to move stocks up and down. I mean, the 1987 crash was caused by a concept called portfolio insurance, and it was probably a predecessor of the types of things we see today, where exogenous factors, computers can, without any human emotion, cause markets to accentuate their up and down moves. So this makes it so that investors have to get educated about more than just like old fashioned fundamental analysis. And frankly, look, these are not negatives. This, to me, the bottom line is this is the golden era of do-it-yourself investing.
Wow. Well, speaking of do it yourself investing, I mean, we have a lot of newcomers in the investment game lately. So, what tips do you have for them, and what are some common traps that they tend to fall in, and how can they be avoided?
Sure. I've written a lot recently about some comparisons of this current era to the dot-com era, which I lived through and managed money through and remember it well. There's I guess what the psychologists call the recency effect. Okay, so things have gone so well recently, or I've only known good markets. Remember, until a couple of years ago, people only knew low mortgage rates and low bond rates. And then it suddenly changed, and the old rules of stocks and bonds moving, to sort of complement each other went out the window. And I think it is a new era for that. So, just on what you've seen very recently, or what you think the kind of time-tested rules are. A lot of those, they haven't changed completely, but they're not as accurate as they used to be. So that's the first thing. The second is everybody, kind of going back to this ABL, avoid big loss concept, know what your panic point is, because you don't want to find out what it is when you hit it for the first time. So I always think risk management, defense first, because making money is, frankly, the easier part. It's just a matter of how much risk you're willing to take to make it. And I think I've kind of described the stock market as kind of like a game of Twister, where everybody's all tied up, and the next move could end the game because somebody's going to fall over and everybody's going to drop on the floor. Well, with the Mag 7 and the tech sector dominating today, those are oddities. They are not. This is not business as usual for equity markets, and it's not business as usual for the bond market. And of course, Bitcoin is a new wild card into this whole thing too, with the ETFs coming out. So there's a lot of things that I think investors, it all comes down to, I think, Rosemary, it's education, but not just education for the sake of education. It is understanding yourself as an investor and finding, let's call it, humble and straightforward tools to be able to teach yourself.
So, education, how does one educate themselves on the stock market? I mean, that's something I struggled with when I first started learning about stocks. I didn't have anyone like you here to teach me.
Well, I'm one of many, but thank you. And I think what you have to do. Somebody taught me this a long time ago. They said, message delivered is not always message received. So when a lot of the messages I think that are occurring right now are a little bit hype driven. Okay, investing has become exciting. It's always been exciting to me, but not exciting because I think that I can, make enough to buy a second home in a month. Okay, but there's a lot of that out there, and I think that look, Wall Street. I've been part of it for 38 years, but I'm also a pretty big critic of traditional Wall Street, and they tend to emphasize things that would appeal to, I don't know if it's the left or right side of the brain, but where you're going to jump on something and it becomes like you're always chasing the last idea. So when it comes to education, I think it starts with learn market history and look at everything with a skeptical eye, actually two skeptical eyes, and start with that. And then in terms of resources, I mean, look, we both are part of a community at Forbes, that among others that try to do that. But all I would say is be very picky about what you don't blindly follow because somebody says this is the best or that's the best. And a lot of it has to do with going back, learning history, learning how markets work, and don't leave your education at the very high surface or headline level.
Mm-hmm. Well, Rob, I guess I'm also wondering, could you tell us the difference between trading and truly investing? Like, as markets are
Hmm.
going up, should you be taking your profits immediately? Should you just hold for the long term? What should you do there?
Yeah, good question there, because you know, it's a personal choice. So I always say people start first with what's my investment philosophy. A lot of what we do at etfyourself.com is I tell people what I do so that they can help themselves figure out what they should do. And we have lots of back and forth commentary and things like that. Uh, so, I think it starts with uh, making it so that you know what your philosophy is, then develop a process to follow that philosophy. Put some guardrails in, again, the ABL, okay? It's not about so much targeting returns, because targeting returns and looking at what did well in the past, it can be very misleading. There's a reason why every fund at the bottom says past performance is no indicator of future returns. It's not. It's no guarantee. And as a matter of fact, the only thing you can guarantee about it is that you can't have it because you weren't invested for it. Okay, so everybody has to figure out what their true objectives are first, and then it's a matter of saying, okay, like what I can tell you, the one thing that has absolutely changed about markets just in the last probably 5 years, like in the pandemic period, is that we're in an extended period now where most stocks have gone nowhere for about 3 years, and interest rates are much higher, but inflation is not resolved yet. And so if you take those two things together, what you get is harder environment to make money by simply buying and holding things for years. And that's part of the history. The stock market has gone 13 years in one case this century without making a dime. That's on the S&P. Most stocks did worse. As we sit here today, there's an ETF that tracks the average performance of the top 1,000 stocks. So it's pretty expansive. The average stock of the top 1,000 in the last, I believe it's 2.5 years, is flat. So all the stock picks and all the other stuff, okay, but you wouldn't know that, right? I can see by your reaction
Mm-hmm.
that you wouldn't know that by looking at the headlines. What does an all-time high mean if it's at its highest level from 2 years ago? It means 2 years of zero return. That's what it means to me. So again, I'm not trying to be a downer or a gloom doomer. I'm just saying, like I said a few minutes ago, look at everything with a skeptical eye,
Right.
and I think obviously in the limited time we have today, that's sort of the highlight. And I will look forward in future discussions to narrowing that down and putting it onto today's market a little bit more than I just did with the top 1,000 stocks idea.
Well, thank you so much for joining me today, Rob. That was incredibly helpful.
All right, thank you, Rosemary. Anytime.